Hi guys. In this unit, we're going to continue in our chapter on finance and accounts, and specifically, we're going to have a look at the sources of finance. So, the point of the chapter is to understand or learn the short, medium, and long-term types of finance. What role does finance play in general for businesses? What are the internal and external sources of finance? And we should also be able to evaluate the appropriateness of sources of finance for a given situation. So we know that in general, we need finance for financing our different business activities. We need to purchase different fixed assets. We might need finance for business expansion, to take over some other businesses in a special situation, such as when we're experiencing decline in sales, or when there is a recession in the economy. We need finance for our working capital, for research and development, and to start up our business. The startup capital can be defined as the capital needed by an entrepreneur to set up a business. So here we would insert, or here under this category, we would put any business license, any, let's say, costs associated with setting up the business, payment to the lawyer, payment to the government. And working capital is the capital needed for day-to-day running activities of the business. It can also be defined as current assets minus current liabilities. This is just a very quick, summary of what finance is needed for, what is the role of finance. And it's very closely related to the previous chapter, which we had, where we talked about capital versus revenue expenditure. In that chapter, we looked at how these differ, how revenue expenditure is different from capital. And this is closely related because for the different types of spending, we will need different sources of finance. Just to recap, for capital expenditure is defined as purchase of assets that last more than 1 year, for example, machinery and buildings. So here we're looking at some long-term assets or long-term uses of money, of our capital. And when we're looking at revenue expenditure, this is spending on all costs and assets, for example, salaries, materials bought, and these can last 1 year and less. So here we would be looking at capital that is tied up for a shorter period of time, for a period of time of 1 year and maybe less. And this chapter, talking about sources of finance, looks at different types of finance, how they differ when it comes to the length of time in which they're tied up. And we're going to have a look at maybe the different sources, whether it's either coming from internal sources or external, and what are the advantages and disadvantages of each. Now let's look at the way how we split sources of finance depending on the length of time for which the finance is used. So if we're using the finance in short term, this means that we are going to be using it we're going to be using the finance for 1 year or less. If we're looking at medium-term finance, this means we're going to be using it around 1 to 5 years. And if we're looking at long-term finance, this means that we'll be using it for more than 5 years. It's basically when I'm saying that we're going to use the money for a certain period of time, this means that the money is going to be tied up in either a certain asset or, the raw materials or whatever thing that we're spending the money on for that period of time. Some examples. So what am I going to buy that, I'm going to use in 1 year or less? For example, short-term finance, short-term sources might be used for things that I'm going to use up in the short term. It can be inventory, it can be raw materials, it can be products that I'm going to be reselling as a retailer, for example. Medium term finance might be used for equipment and assets that I'm going to use in the medium term. Let's say I'm going to buy a computer, and I'm going to, in 5 years, I'm going to, buy a new model. So maybe for equipment, for cars of this sort, we might use medium-term finance because these assets are going to be used by the business between 1 and 5 years. And when it comes to long-term examples here, we can have buildings, we can have land. Very often it's very expensive projects or very expensive assets that we're going to be using for more than 5 years. And for those types of assets, we will need to use long-term sources of finance. The idea or the point that I'm trying to make is that the type of finance that you as a business will need is going to very much depend on what you are going to spend the finance on. The idea is that if you're buying something that is going to benefit your business in the long term, so you're going to make some capital expenditure, you should find a long-term source of finance. There are two types of sources of finance, internal and external. And the distinction really comes from where the finance is coming from. If it's the internal source of finance, it is raised from the business's own assets or for profits left in the business. So some examples can be the personal funds of the owner. It can be profits which have been reinvested back into the business, retained profit, or you can raise internal finance through the sale of assets, most often unused assets. The external finance is raised from sources outside of the business. And here we distinction between three types: debt finance, equity finance, and other forms of finance. We'll talk more in detail about the external sources of finance later on in a different video. At the beginning, or right now, we're going to have look at the internal sources of finance, which, as we said, are raised from the business's own assets or from the owner's assets or from profits left in the business. The first type of internal sources that we're going to cover are personal funds. So personal funds, these are most probably going to be used by startup businesses, by smaller businesses, sole traders, or partnerships. And the idea is that the owner is taking their own personal savings and investing it into his own business. The disadvantage is that obviously the personal savings are going to be limited. Usually, the owner is going to use these savings up when starting a business. On the other hand, the advantage is that if you're going to be using personal funds, you can do whatever you want with them. The owner has absolute control over his business. He doesn't need to ask any investor whether he can spend the money this way or some other way, and you don't become indebted to a different entity. Retained profit is, as we said, the profit invested back into the business. It's the profit left after all deductions, including dividends, have been made. So the idea is it's kind of plowed back into the company. It's reinvested. You're not going to, at the beginning of the life of the company, you're not going to be at the beginning of the life of the company, you're not going to be using the profit for your own personal gain, but you're going to use it in order to make the business grow. It is a very significant source for already established companies. However, as we know, retained profit is not very high when you're a startup. Maybe for the first few years, some companies are even going to experience losses. So you cannot really rely on this source of finance in every case. The third type of internal source of finance is the sale of assets. Selling assets which are no longer needed in the company, or selling to maybe a leasing specialist, can be an option for the business when you need to raise more finance for example, some investment or to cover your liabilities. The good thing about this is that you can still use the assets if needed, for example, by leasing back the asset. And this is going to create an extra cost, a fixed cost. However, at the beginning, after the sale, you're going to get a large sum of money that you can spend right now for anything that you want. An example, which I'm taking from the textbook that we're using, the Simpson, Peter and Alex Smith Businessman Management textbook, is the example of HSBC, a large international bank. It actually sold its London headquarters for $2 billion, but then later they stayed in the building and they leased it back from the new owners. They were paying a rent of $80 million. Obviously, this was a fixed cost, but at the same time, they exactly after the sale, straight away they had a large sum of cash, a large sum of finance that they could use elsewhere, however they wanted. Internal sources of finance are therefore a great source. It gives you control. You don't need to dilute the ownership of your business. However, to summarize the weaknesses, it is limited very often, and you cannot rely on sale of assets over and over. Yeah, you only have a limited number of assets that you can sell. And some of the assets you cannot sell because you're using them, right? So, as you can see in this activity, which I also borrowed from the textbook, there are different cases listed where we have to explain briefly why the internal sources of finance might be unavailable or inadequate. Let's maybe have the next few seconds. Please try to go over these different scenarios and try to explain, using your own words, why the sources of finance might be unavailable or inadequate, and maybe what would be some other options that the businesses could take. Okay, pause the video if you haven't finished, and in the next video, we're going to have a look at external sources of finance.